Good morning. We are Team G, here to present our investment analysis on Carter's. My name is Luke Hand. With me today is Alina Narani, Shannon Doherty, and Dylan Mitchell. We issue a sell recommendation for Carter's with a target price range of $37 to $45 over the next 12 months, with a base case target price of $42. This represents a 0.72% downside from last Thursday's closing price of $42. We chose a representative peer group of Gap, Urban Outfitters, Children's Place, and Hanes. Our sell recommendation for Carter's is based off of 5 key investment thesis points: declining addressable market, declining purchasing power, poor working capital management, neutral valuation, and management uncertainty. We will go into each of these after a short business overview. Carter's derives 85% of its total revenue from North America. However, its main source of raw materials comes from China, where they derive 60%. Their main manufacturing base is in Hong Kong. The U.S. remains Carter's most dominant geographic market in terms of number of stores and total revenue generated. Carter's also has 2 main distribution channels, in which are wholesale and direct-to-consumer in the U.S. and internationally. Finally, Carter's has an extensive brand portfolio in which their 3 main operating brands are Carter's, Oshkosh, and Little Planet. They also segment their revenue into 4 main categories. These are baby clothes, play clothes, sleepwear, and others, with baby clothes and play clothes representing 70% of their overall revenue. Now I'll hand it over to Shannon to talk about their ESG initiatives.
Thank you, Luke. In 2019, Carter's established its current ESG framework, Raise the Future, which is a 3-pillar program focused on product, planet, and people. It also established an extensive top-down ESG hierarchy. These factors significantly contribute to Carter's ESG scores ranking favorably among its peers. Carter's environmental goals are broken down into emissions and energy, waste, and water. Their environmental disclosure scores rank higher than its peers due to the decline in carbon emissions. However, this reduction has been achieved primarily through indirect means. Carter's social scores rank slightly below the peer average due to a decline in ethnic leadership diversity at the district manager and vice president level, which has been declining at a 4% CAGR since 2021. Additionally, monetary giving has been declining since 2021, making it doubtful they will reach their $50 million target by 2030. For governance, we use the Institutional Shareholder Services scores, which range from 1, minimum risk, to 10, maximum risk. Scores are then further subdivided into audit, board structure, compensation, and shareholder rights. Carter scores a 1, which is below the peer average of 4, indicating lower governance risk. However, our team has concerns over the board structure, shareholder rights, and compensation. Overall, the lower social scores and the governance risk reaffirms our sell recommendation. Dylan will now talk about our first investment thesis point.
Thank you, Shannon. Carter's performance heavily relies on birth rates in North America, as it derives 85.4% of its revenue from these key North American markets. However, between 2019 and 2028, birth rates are expected to decline at a CAGR of 1.2% in North America, posing a significant threat to the firm and its overall operations. Furthermore, Carter's Chief Retail and Digital Officer, Allison Peterson, has said that, quote, "We anticipate 2/3 of expecting and new parents will be Gen Z in 2025. However, Gen Z currently only accounts for about 20% of North America's total population, further amplifying Carter's concentration risk in an already declining addressable market and reaffirming our sell recommendation." I will now hand it over to Luke to discuss declining purchasing power.
Thank you, Dylan. As we look at the macroeconomics of the industry, it's hard to deny the strain being put on Carter's consumers. As we can see, over the past few years, inflation rates have largely declined, even though they're still above their historical averages of 2%, dampening consumer purchasing power. In conjunction with inflation, disposable income has largely stagnated in the U.S. and Canada since 2021. And as Dylan mentioned, Carter's expects 2/3 of expecting parents to be Gen Z in 2025. In addition to that, Gen Z has the lowest spending and income out of any generation. And as you can see on the right, they also have the lowest spending in apparel. Finally, we ran a regression analysis indicating a negative relationship between real disposable personal income and birth rates. Furthermore, a 0.01% drop in fertility rates results in 17,000 less children per year. Now I'll hand it over to Alina to talk about poor working capital management.
Thank you, Luke.
Carter's employs a pack and hold inventory management strategy where they build up an inventory increasingly in 1 year and sell it off subsequently in the following years. As a result of this, we basically looked at Carter's cash conversion cycle to assess this working capital strategy using days inventory outstanding, days payables outstanding, and days sales outstanding. If you can see in the graph on the right, Carter's cash conversion cycle is consistently higher than its peers, primarily driven by a longer days inventory outstanding, which is on average 17% higher than its peers. A longer cash conversion cycle ultimately implies higher investment in working capital, lower free cash flows, and all else equal, lower firm value. Carter's average current liabilities over current assets of 0.4 trail substantially lower than its peers, indicating that Carter's finances 60% of its current assets using long-term liabilities. In addition, this is supported by Carter's taking out regular borrowings in its secured revolving credit facility, which allows borrowings up to $850 million up until their term ends in April 2027, and this is to primarily aid its working capital. Due to this, with this conservative working capital strategy, Carter's loses out on potential investment opportunities in their capital expenditures that can organically grow its firm. In addition, its capital deployment strategy emphasizes the cash return to shareholders despite declining cash flows. Carter's cash dividends have increased in the past 10 years at a 10-year CAGR of 14%, with its dividends payout ratio increasing from 27% in 2020 up to 63% in 2024. Despite this, their revenues and their cash flows have been decreasing, which shows their inability to sustain that cash return to shareholders. Next, our recommendation is further supported by Carter's neutral valuation, where we use the following 5 models. The relative valuation model weighted at 40%, the discounted cash flow model weighted at 30%, the multi-stage residual income model, the dividend discount model, and the Monte Carlo simulation, each weighted at 10%. Here's a summary of our inputs, as well as the downside and upside target prices yielded by each model on the right-hand side of the screen. We also included the relative valuation multiples that we used, including EV over EBITDA, which we wanted to highlight. EV over EBITDA is enterprise value over earnings before interest, taxes, depreciation, amortization, and rent expense. And we selected this primarily due to the brick-and-mortar nature of the industry that Carter's and its peers are in. We also conducted sensitivity analyses for DDM and DCF. For the DDM, we varied the cost of equity and the growth rate. And for the DCF model, we varied the free cash flow to the firm up against the discounting rate. In addition, we ran 100,000 Monte Carlo simulations that yielded downside base and upside target prices of $39.50, $45.20, and $52 respectively. I will now pass it off to Shannon to discuss the management uncertainty.
Thank you, Lena. Since August 2008, when Michael Casey began its tenure, Carter stock has yielded a positive gain. However, it has underperformed the apparel industry, the Consumer Discretionary Index, and the S&P 500. On January 7th, 2025, Michael Casey announced his retirement from CEO after a 17-year tenure. Currently, the company is exclusively looking for external candidates, specifically one which will increase its omni-channel capabilities. Overall, our team is concerned over the future of the CEO, which reaffirms our sell recommendation. Dylan will now talk about further considerations.
Management and analysts that tout the stock have based their confidence upon a strong dividend yield and consistent value creation. However, the reality of the situation is much more bleak. Carter's dividend yield has remained lower than the risk-free rate in 8 out of the last 10 years, meaning that investors would have been better off on average purchasing a 10-year treasury rather than relying on Carter's dividend yield. Furthermore, Carter's has been touted as a consistent value creator. However, its ROIC versus WACC spread has been declining at a CAGR of 11.4% since 2019, meaning that the firm is quickly transitioning into a value destroyer and losing its economic moat. To reinforce our investment thesis, we issue a sell recommendation based upon a declining addressable market, declining purchasing power, poor working capital management, neutral valuation, and management uncertainty. For Carter's long-term survival, we propose 2 strategic directions. 1, being a merger with a highly diversified firm within the apparel industry, or 2, exploring an organic growth strategy that provides the firm with geographical diversification.
Thank you. We are now open for questions.
So one of the statistics on one of your slides talked about the book value, which I think was in the 27 ballpark. have you thought about the intangible assets that are on the balance sheet, which I think add to about $13 per share?
Yeah, so definitely one of the big aspects is Carter, like Luke said, Carter's does have an extensive brand portfolio, which does increase its intrinsic value. However, we still feel like these values are accounted in some aspect of the balance sheet. And Alina went ahead and there's further valuation methods in which we use to overall kind of reemphasize the our valuation methods, and Lena can further talk about those.
Yeah, I can also speak to how a lot of those is usually the trade names and a lot of the brand names, but in the past couple of years, especially in this past year, they've been regularly taking out impairments or loss on those impairments, which have we've seen that the value of those trade names has gone lower and lower, so ultimately that does further reinforce that sell recommendation that although they have those intangible assets, they are being impaired over time.
And I will say that one of the key points is because they do have that extensive brand portfolio, that really does link back to our ending slide about our strategic initiatives and the merger with potential wholesalers and the apparel industry and geographic diversification. In their last earning call, one of their main sources of revenue was coming from their wholesalers where they were utilizing them in order to sell their products. And ultimately, that will allow Carter's, if they go ahead and merge with them, that will be the most profitable aspect for their firm, as we are seeing that in their standalone stores, which house their main brand portfolio, they're actually seeing a decline in those retail brick and mortar stores, which kind of reaffirms our sell recommendation and also reaffirms our strategic suggestions.
So you're talking about declining addressable market. Have you looked at their market share? Is it only Carter's problem or their competitors dealing with the same issues?
Luke, could you go down to the appendix for us?
So overall, they do have a strong market share, but the market is extremely fragmented, and Dylan will go more into that.
Yeah, so since 2019, both Carter's market capitalization and its market share as a percentage of the specialty apparel industry, as well as the children's apparel industry, has been declining over time, while some of our peer groups, such as Gap, has maintained overall steady margins, steady revenue, overall just steady performance. However, their most direct competitor, Children's Place, is also facing the problem of a declining market share with their growth and revenue projections. So we do believe it is the overall addressable market for the children's apparel industry.
We also see a lot of their wholesale distribution centers as kind of eating their lunch. They tout Amazon, Target, and Walmart as their main wholesale distribution channels, but those have their own individual brands within that they're selling, the Target brand, the Walmart brand, that are sold at a discounted price. And so they're actually losing a lot of their market share to their own wholesale distribution channels.
Can I see the dividend discount model slide, please?
Do we want to go to it here?
Nope,
Or would you
that's
like
not
to
the
see?
slide,
Okay. Here we go.
That slide?
Yes, sir.
Okay. Why isn't the cost of equity affecting the valuation there, the share price?
So that might be an error on our sensitivity analyses, because it should be affecting it. But ultimately, we did find that the cost of equity did vary it up between $46 to $52. I believe it could have been an Excel error, but we ultimately felt that it was a variable when we were going through our analyses that showed how sensitive the price was to it. But I believe it's not true.
When we looked at the working average cost of capital and the growth rate, these were the two main sources of fluctuations within the DDM and the DCF. So as you can see on the right, we do show that our growth rates and our WACs are the main key drivers of the value of the stock fluctuating. even though our numbers have not changed with the cost of equity at the top on the DDM.
While we're on this slide, can you tell us why, or elaborate further on why you think the stock is still a sale? Because I know you submitted your written report when the price was a lot higher, and in hindsight, sell was the right recommendation. But just look at the Monte Carlo here, for example. You know, your base is 45, the stock today is 41, so it has, according to this, limited downside and more upside. And I'm thinking that whenever they fill the CEO position, sometimes that's a nice catalyst for a stock to move up.
So to your point about the CEO, actually in 2022, they had a huge shift in management where they announced that they had 4 new board of directors, and since then the stock has actually been declining, and it's declined at 30%. So we still feel like it is doubtful that even when they put in a new CEO, that yes, there may be a temporary increase in the stock price, but overall the fundamentals of the company are still the same. They're still going to be facing problems over declining addressable market, over declining purchasing power. Yes, while the Monte Carlo does provide a graph of the downside and the the downside, the upside, and the base case, and while we do expect that after the earnings call, the stock will kind of subside and plateau, we really still feel like the fundamentals of the company are still signaling a sell recommendation, and they can go ahead and they can further discuss those points.
In addition, we weighted this only at 10%, and although this was done with kind of that previous stock price in sight, we felt that other valuation models best represented both the market sentiment, including those industry headwinds that have been heavily affecting their earnings, as well as the internal structure, and that goes to their operation management, including that core working capital management, which is why we weighted the relative valuation at 40% and 30%. And with relative valuation being one of our most objective valuation models that we kind of feel, and it uses those industry-specific multiples that we feel best measure the intrinsic value of these firms, including Carter's. That's ultimately why, regardless of kind of Monte Carlo yielding those higher prices, we still felt that there were other models that kind of best measured it, and so we reflected that in our weighting. But we still felt it was important to kind of speak to the simulations that we have ran.
Additionally, that we also use some valuation methods that we didn't actually account for in this. For example, we utilized the PEG ratio, which does indicate that they are still going to be overvalued compared to their peers. And Dylan can go ahead and further talk about that aspect.
Yeah, so when we look at the 1-year forward PEG ratios, or the price to earnings over the growth, we see that Carter's has a higher PEG ratio than all of its peers aside from Children's Place. However, the similarity between Carter's and Children's Place is the less than 1% growth rates, which is further strengthening their high PEG ratios and signaling that overvaluation. When we look at Carter's growth rates, and when listening to their earnings call on this past Tuesday, management noted that the children's apparel industry has been growing at less than an average 1% growth rate since 2019, and especially since the pandemic, they have not been able to jumpstart their operations back to where they once were. And we continue that growth to not only continue, but also decrease than that less than average 1%.
Additionally, on their earnings call, they further reiterated the urgency that the firm is having in order to solve the problems at hand. They constantly contradicted themselves when they were discussing the issues, which further recommends the intrinsic problems that they're facing. Additionally, all the other movements, Carter's is very a lateral organization, very vertical, and so most of the times they have recruited a CEO from inside the company. However, they are concerned with the issues that they're facing and recognize that their internal management cannot solve it, and then therefore they are trying to seek external help in order to try to reaffirm the company as a whole.
And ultimately, we did change from a negative valuation in our report to a neutral valuation to reflect the decrease in the stock price. And ultimately, when we think about it and we look at a new CEO coming in, we could see them tackling some of the issues that Carter's faces, and we really hope that does happen. But at the end of the day, the total market is declining. In the US, Canada, and Mexico, birth rates are declining, as we've seen. And so Carter's can do as much as it wants, but if its total addressable market continues to decline as it is, we don't really see a way that they can combat that.
What has to change in the fundamental factors for you to change your recommendation to the buy?
Last question.
Yeah, so we believe that Carter's overall growth strategy needs to change. Again, when listening to their earnings call this past Tuesday, they reinforced their two-pillar growth strategy approach, which included improving their product mix and as well as their marketing initiatives. We believe that Carter's has one of the strongest brand portfolios in the children's apparel industry, which happens to make it a very attractive company for a potential merger with a highly diversified firm within the apparel industry. In regards to their marketing initiatives, we do not believe that marketing with their target market to Gen Z is going to work, just given the macroeconomic conditions and declining purchasing power that Gen Z is facing, as Luke previously discussed. So for Carter's to be able to grow and get out of this sort of rut that they are in, we stand by these two strategic suggestions of one, either being a merger with a highly diversified firm in the apparel industry, or two, that organic growth strategy that provides the geographic diversification to the firm. And I can go into that a little bit more. When analyzing Carter's potential organic growth strategies, we've identified potential growth markets like Brazil, Colombia, India, the Philippines, and Indonesia, where there are higher birth rates coupled with rising disposable income. And while our regression analysis earlier showed that higher rising disposable income does not correlate with rising birth rates, that was strictly for North America. But when you take the average of our identified markets and run that same regression analysis, the point of rising birth rates coupled with rising disposable incomes correlating stands true. So we believe that the firm can expand into these key countries through strategic partnerships and more licensing agreements. And we believe that they have the capital to do that. And we think they can do that through their projected cash flows by utilizing that excess free cash flow and improving or redesigning their capital deployment strategy to increase its capital expenditures, as Alina said earlier, and achieve this organic growth.
Thank you.